Hello and welcome back to Global Value. In today's video, we're performing a fundamental stock analysis of Equinor ASA, ticker symbol EQNR. We're looking at Equinor today as a subscriber request, taking a look at the company's US listing through their ADR. Currently, the business is trading for $29.11 per share, and over the last year, their stock price is up 2%. Over 5 years, Equinor is compounding at a rate of 5.5% annually. Over 10 years, they're only compounding at a rate of 1.5% annually. And going back prior to the global financial crisis, over the last nearly 18 years, Equinor is compounding its stock price at a rate of about 3.5% annually. Keep in mind that the company is a major dividend payer as well. Their average dividend yield throughout this time would be in addition to this compounded annual return. Currently, Equinor pays out about a 2.8% dividend yield, which is almost double the yield that you'd be getting from an S&P 500 ETF right now. And over the last 10 years, Equinor's median dividend payout has been about 4.6%. Again, that covers a 10-year time frame, but their average dividend yield throughout this time would be in addition to this compounded annual return, netting a better result over this period for shareholders overall. So we're also looking at Equinor because the company is currently trading just $1 over their 52-week low. They're down $13 from their 52-week high. Equinor is a very large business and one of the largest businesses in Norway. It has a 948 billion Norwegian krones market cap, which when converted to USD is about 93 billion US dollars. So Equinor is a large business. For more background about the company, Equinor is a Norwegian-based integrated oil and gas company. It has been publicly listed since 2001, but the Norwegian government retains a 67% stake. Operating primarily on the Norwegian continental shelf, the firm produces 2.1 million barrels of oil equivalent per day in 2021, which was 52% oil, and it ended the year with 5.4 billion barrels of proven reserves, which were 49% oil. Operations also include offshore wind, solar, oil refineries, and natural gas processing, marketing, and trading. The company was formerly known as Statoil ASA and changed its name to Equinor ASA in May of 2018. Equinor ASA was incorporated in 1972 and is headquartered in Stavanger, Norway. So for our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of Equinor based off of their business fundamentals. This analysis is still a work in progress and it's an opportunity to learn in public, so it will continue to evolve, improve, and get better over time. With that said, let's get right into today's analysis. Starting things off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. And there are 2 key reasons for this. The first is that over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns, and these business returns are going to be captured here by return on capital. The second is that the average publicly listed business earns about a 7% return on capital, so by looking for a benchmark of 14% or higher here, we can potentially build in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average. So Equinor, as an integrated oil company, is going to see its returns on capital fluctuate with the pricing of oil and natural gas. This is well evidenced in their return on capital numbers, which went very low in 2020 when the price of oil actually went negative. Since then, as the price of oil has rebounded, their return on capital has also rebounded. In 2021, the company earned 36% returns on capital, and over their last 12 months, the business has actually earned 84% returns on capital, which is dramatically higher than where they were at in any of these previous 5 fiscal years. Averaged out over these last 5 fiscal years, Equinor is earning about an 18% average return on capital, which is above that 14% benchmark, so that's nearly 2.5 times better than a typical business. So this is a check here on metric number 1. Even though they're a cyclical commodity producer, the company is earning very high returns on capital, even if they can be a bit lumpy in some years. Next up, for metric number 2, here we're taking a high-level overview of the growth of their business. So we're looking for revenue, net income, and free cash flow growth over the last 5 years. And this metric is going to be all or nothing in nature. Either all 3 of these are going to be up for this to be a check, or if even one of these is down, this entire metric will be an X. When we include their last 12 months worth of numbers, Equinor has really experienced pretty explosive growth in their business. The company has brought in total revenues of $147 billion over their last 12 months alone, which means that their revenues have grown by about 2.5 times. Their net incomes are up by more than 5 times, and at the same time, their free cash flows have increased by about 7 times. So this is massive growth across the board here for Equinor. The company has been performing exceptionally well since the COVID-19 pandemic lockdowns on the back of this increase in the price of oil. So this is a big check here on metric number 2. Also worth noting about the business is that they were free cash flow positive in all 5 of these years, even when the price of oil went negative in 2020. It's great to see such strong growth here for Equinor, and it's especially great to see such strong growth led by their growth in their free cash flows. This highlights some operating leverage in the business, as free cash flow is really the lifeblood of any business, and ultimately a business's abilities to produce free cash flows now and until Judgment Day, discounted back by some reasonable interest rate, is what that business is going to be worth. So a business can use its free cash flows to reinvest back in the company, make acquisitions, buy back shares, pay down debt, or pay dividends. So just another very strong check here for Equinor. Next up, for metric number 3, here we're taking the perspective of an individual shareholder in the business by looking at Equinor on a per share basis. So we're looking for earnings per share growth over the last 5 years. In our previous metric, we learned that their earnings are up by 5 times over this time frame, and additionally, Equinor has had marginal share buybacks. They've repurchased about 2.5% of their shares outstanding over this time frame, which has led to strong earnings per share growth for the company. This is a check here on metric number 3, and over their last 12 months, the company has earned $7.54 for each share that they've had outstanding. Next up, for metric number 4, here we're looking for something very similar, which is free cash flow per share growth over the last 5 years. This is seemingly the same story as their earnings per share, as their free cash flows have grown by more than 7 times over this period, and with those slight share buybacks, their free cash flows per share are up as well. For another check here on metric number 4. For each share that they've had outstanding, Equinor has brought in $9.64 worth of free cash flow over their last 12 months. And so with a check here on metric number 4, this means that through our first 4 metrics, we are a perfect 4 for 4 for Equinor. Next up, for metric number 5, here we're evaluating how the business is utilizing leverage. So we don't want to be investing in overly levered businesses, because during economic downturns, it's overly levered businesses that are going to be at the greatest risk of poor outcomes. We want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow that the company has produced over the last 5 years. Equinor basically has used their excess free cash flows to significantly deleverage the business post-2020. They ended 2021 with just under $900 million of net debt, and right now they have about $12.3 billion in cash. Over the previous 5 fiscal years, Equinor has produced $38.6 billion of free cash flow, and over their last 12 months, the company has produced $30.8 billion worth of free cash flow. The company is massively cash flow generative relative to the debt that they're employing currently. This is a huge check on metric number 5. And over the past 2 years alone, Equinor has produced more than $51 billion in free cash flow, which is astronomical compared to the debt that the company's employing, and extremely high relative to their market cap. With yet another check here on metric number 5, we are still perfect 5 for 5. Let's see if Equinor has what it takes to go perfect on our Select 6 analysis. Then our 6th and final metric, the big metric of them all, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this will potentially offer us a slight risk premium to the yield of the 10-year treasury, and potentially give us a reasonable starting point for a valuation of the business. Right now, Equinor has about an $80 billion total enterprise value, and we're using their total enterprise value because it takes into account both their market cap and their net debt position. Because the company has net about $12 billion in cash, this means that their total enterprise value is actually below their market cap. And we learned in the previous metric that Equinor has produced $38.6 billion worth of free cash flow over their last 5 fiscal years, meaning that in an average year over this time frame, Equinor is producing about $7.7 billion of average free cash flow. So when we divide their $7.7 billion of their average free cash flow by their $80 billion total enterprise value, that gives us about a 9.6% average free cash flow to enterprise value yield for the business. So that's nearly double that 5% benchmark we were looking for, and that's about 3 times better than the yield of the 10-year treasury. So it does look like Equinor would be potentially offering a pretty significant risk premium to the yield of the treasury. And so with a check here on metric number 6, this means that Equinor has done it. They are a perfect 6 for 6 on our Select 6 analysis. Just because this is the case, however, doesn't mean that you're going to go run out and buy the business. This type of analysis is not financial advice, and it's meant to be holistic and beginning in nature. Really, it can help to inform you that Equinor may be potentially a very interesting business to dig into and learn more about, based off of looking at its financial fundamentals. Also worth being aware of is that, again, over their last 12 months, the business has produced $30.8 billion worth of free cash flow. So to get a current free cash flow to enterprise value yield for the business, when we divide their $30.8 billion of their last 12 months of free cash flow by their $80 billion total enterprise value, that gives us a 38.5% current free cash flow to enterprise value yield for the company. which is a very high yield for pretty much any business, especially a business as large as this. So even though the business goes 6 for 6 on our analysis, we also want to see if we can come to a more concrete version of an intrinsic value for the company. But before we jump into that, here's something interesting. So as a bonus, here we're looking at Equinor's dividend profile. Again, Equinor currently pays out about a 2.8% dividend yield, which is about double that of the yield that's being paid out from an S&P 500 ETF currently. However, people make mistakes by blindly chasing dividend yields, so it's important to stop and look at the underlying fundamentals of a business like we've been doing, and to determine whether those dividends are well supported by either the earnings or the free cash flows of the business, depending on the type of business. For Equinor, we want their dividends to be supported by their free cash flows, and that's been the case in all 5 of these years, especially since 2020 as the price of oil has dramatically increased. The company's free cash flows are very easily able to pay out their dividends, and the company has issued multiple special dividends over the past 2 years because of these excess free cash flows, and now given the fact that they're sitting on about $12.5 billion worth of cash. So you would want to read through some of the company's filings to understand what exactly they're going to be doing with these free cash flows going forward, if the company manages to still have excess free cash flows over this time frame. But it looks like Equinor is doing a good job of supporting their dividends, and the company's free cash flows have been pretty massive over the last couple of years. Then everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Equinor, which takes us on to using a discounted cash flow model to come to a potential fair intrinsic value for Equinor. Here we're starting with an average of their free cash flows over the last 3 years to give us a more normalized perspective of the business's free cash flows. Then we're using historical growth assumptions based off how Equinor has grown their free cash flows since becoming a publicly listed business in 2001 to give us a baseline projected estimate into the future for the company. So it's up to you to do your own homework here to determine whether or not these are going to be potentially accurate and applicable going forward for the business in order to give us that baseline projected estimate. But if we assume that they can grow their average free cash flows at a rate of 7.4% annually over the next 10 years, and then we assume a terminal stage for the 10 years out after that, where they grow these free cash flows at a rate of about 4% annually. If we add in their tangible book value, which gives us an approximation of the company's tangible net worth per share, and we were ideally seeking a 15% rate of return, which is the rate of return that Warren Buffett is looking for from his investments, then it looks like at today's valuations, a reasonable fair intrinsic value for Equinor is around $56 per share. Based off of this, it does look like there's the potential that there's a large amount of margin of safety embedded in the company's current stock price, and that the company would be leaning toward being undervalued. Keep in mind a couple of caveats here. One is that because this is an integrated oil and gas company, their business is going to be cyclical in nature. Even as the demand for oil has grown over time, this industry has been prone to boom and bust cycles with periods of very high and very low capex. And we saw some of those lumpy results in Equinor's financials. Secondly, this 15% discount rate would be including their dividend yield, so we would not be doubly counting their dividends, and 2.8% of this 15% would be coming directly from the company's dividend yield right now. Also, a discounted cash flow model is based off the predictability of a business's future free cash flows. So with an energy business, there are reasons why these free cash flows may not be as predictable as the free cash flows of some other types of businesses. So again, it's important to dig in and do the work here. And please be mindful of the fact that this type of analysis is not financial advice. It's not a buy or sell recommendation of any security. And before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. So in summary, Equinor checks the box on all 6 of our metrics today. They go a perfect 6 for 6 on our Select 6 analysis. They earn average returns on capital of about 18%. They've grown their revenues, earnings, and free cash flow significantly over this time frame, also buying back a small amount of their shares outstanding. The company currently has more than $12 billion worth of cash after very aggressively paying off all of their debt. And it looks like the company is very attractive to dig into and learn more about. When we look at both their average and their current free cash flows to their enterprise value and compare that to the yield of the 10-year treasury. Then finally, when we performed a discounted cash flow analysis of Equinor, if you were ideally seeking a 15% rate of return from the company, and you had done the work to verify that those historical growth assumptions are accurate and applicable for the business, then it looked like a fair value for Equinor was about $56 per share, and that there could be significant margin of safety compared to their current stock price. So again, even though the company both was a Select 6 stock and they looked attractive off that DCF model, it's important to understand that with commodity businesses, because they're cyclical in nature, they can look during their boom cycles, they can look particularly cheap on some of these valuation multiples, and during some of their bust cycles, they can look very expensive on these same multiples. However, that would be inverted from what would be ideally the best point at which to buy those companies. Not necessarily saying that we're either at a boom or a bust for the industry, as I'm not an expert in integrated and international energy businesses, but to understand this company in more depth and to understand the global energy sector as a whole, you would need to do the work and have some sort of insight in order to have an edge into the business. So with that said, it's worth reiterating that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with your financial advisor. Instead, this analysis serves as a beginning and holistic understanding to help you determine whether it's worth your time and energy to dig in and learn more about Equinor, which based off of their financial fundamentals, it does look like the business would be pretty attractive to look into. One resource that will definitely help you stay up to speed with what's going on in the market and help you learn more about the business is Seeking Alpha. Checking out Seeking Alpha directly supports the channel as I'm part of their affiliate program. So most of you probably know Seeking Alpha as a source of community written articles on different stocks. But over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's algorithm. You can see earnings call transcripts, investor presentations, SEC filings, and press releases all in one place. You can add your own margin of safety targets and get alerts for when your favorite stocks hit that level. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can get 10 years of financial data on any stock to help you with your analysis. You can also import your portfolio into your Seeking Alpha dashboard to make researching easier. And if that didn't convince you, the best thing is that an annual plan is only $119. That's just 33 cents per day through my referral link down in the description below. Normally premium is $239, but if you use my link, it's 50% off. So check it out if you're interested. So through this deeper research, you'll learn more about the qualitative and the quantitative aspects of Equinor, and you'll likely be able to determine for yourself what a reasonably appropriate intrinsic value for the company will be. As a value investor, you're ultimately trying to conduct this research as if you're going to own 100% of a business, and you can truly understand its underlying essence. You want to learn accurately, completely, and then you also want to go back and ask yourself, what did you miss? To understand what's going to be important and what's not going to be important for the company going forward into the future. So with that said, that's it for today's fundamental stock analysis of Equinor ASA, ticker symbol EQNR. Again, we looked at the business as a subscriber request, and it fits with our ongoing theme of looking at energy businesses. Plus, with Equinor looking like it's a potentially attractive business to dig into, I'm happy to make an analysis of the company. And if you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Equinor with me, and have a great day.